Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello, everyone. Welcome to today's Top Stock Picks. I am Jeremy Mullen, and Tracy will follow me. But first, I have an interesting AI play that I think will do very well in 2024. The stock is a Zacks rank number 3 hold with ticker symbol PATH. That is right. It's UiPath. This company provides an RPA platform that uses AI to automate repetitive tasks and streamline business operations. Now, if you are not familiar with RPA, that stands for Robotic Process Automation. RPA is a technology that allows businesses to automate repetitive and rule-based tasks by using software robots. These are often referred to as bots. I'm sure you heard of those before. These bots can mimic human interactions with digital systems, such as navigating through user interfaces, interacting with applications, and performing data entry. Now, PATH has surged after a recent earnings report, so I want to dig into that quarter and see where the stock might be going. So let's look at the slides. I did something a little different. I grabbed a bunch of slides from their conference call slideshow, but first, looking at this first chart, I have the Zacks.com profile page. And one thing that sticks out to me, of course, you get the Zacks rank number 3 hold. One thing that sticks out is this A style score in growth that pairs with an F value score. Okay, so this is common in a lot of tech stocks that are growing fast. If you look down here, we have a forward PE of 60. So a lot of people have a problem with that. That's not crazy, but it is high. And what you need with that is you need that EPS growth 3 to 5 years of 47%. That's pretty good. So as long as that can keep going, we can justify this high PE. And with that, you have a $14 billion market cap, which has recently been increased from the stock surge. You can see in the chart here, we had earnings that we're going to talk about, but the stock moved from 19 to 25. So what we're seeing is nice earnings growth, a high valuation, and a stock going higher on recent earnings. So let's dig into all that. The next slide we have is the EPS surprise chart. And this is going back to when they IPO'd, okay? So now back in 2021, tech stocks were getting pretty high valuations, right? So then this IPO'd at the right time for the company, but the wrong time for investors. Because every time they bought, it went down. We see some great earnings beats and some horrible reactions, right? So obviously this was a tough time for tech, and the stock bottomed out right about the beginning of the year in 2023. And we continue to see some nice earnings beats, but the stock just couldn't get going until recently. We finally have a positive reaction to earnings, which is very interesting and is going to catch a lot of eyeballs, okay? So after this move, the stock is up over 100% on the year. So finally, a nice year for the stock. Now, what we really have to watch going forward is these earnings estimates. They just had earnings a couple of days ago, so not a lot of analysts out raising estimates quite yet. I saw Truist raise theirs. They have a $28 price target on the stock. But other than that, not a lot of action yet. So I want you guys to look at these numbers. Over the last 7 days, we see a little tick, but keep checking in on here. If these estimates start to tick higher, the stock will follow suit. So this can be found if you click on estimates. That'll give you the agreement, which is how many analysts are raising. And then you can see the magnitude, or you can see the actual numbers moving higher or lower. And what we want to see in the current next quarter and current year is for these numbers to go up. And so here are the slides from the actual presentation. I really like this because it kind of shows you their process. So they discover high ROA opportunities, and then they build their AI bots, and these kind of like the different ways they do it. And then they execute, right? They operate, and they have continuous testing and analytics to help them do so. So this is kind of their process, which is nice to understand, because a lot of this AI stuff is complicated. And then this is their autopilot. Like, who's going to use this stuff, right? Well, developers, testers, analysts, and everyone. Anybody who wants to be more efficient, save time, and basically save money and pad that bottom line is going to want to try to use this stuff. And so with that, we're starting to see them make some money. So we see some revenue growth here, 24%, pretty good numbers. Their ARR is over 1.3 billion now. So this stuff is continuing to go higher, and it's going in the right direction, which is obviously great for the stock. One of my favorite slides here is the customer momentum. And you can see the smaller customers, great. It's great to see this going up. But what I really want to pay attention to are these larger customers with over $1 million ARR. We have a big jump. What is this? 30% about jump. And so next year, I want to see this keep going higher. I want to see over 320 or so and continued momentum with these larger customers. That's really going to help revenue and eventually the bottom line. So this compound annual growth rate is important too. So the CAGR, 35% is a great number to post. And you can just see bottom left to upper right. We want to keep that direction going. So overall, all these fundamentals are looking great. And what happens is the stock responds, right? So we see this pop here. You guys know I like the fib. So immediately what I do is I go to see where the stock has retraced. And we have not seen really a retrace upwards. I mean, we see some smaller bounces, but nothing really since this IPO high. So from highs to lows, I have a sell zone way up here, which would be another double for this company. So that's now from a $15 billion to a $30 billion company. So how do we get those there? Well, the fundamentals have to keep improving. But this is a lofty goal. So let's zoom in here. I have another micro fib, which was around the $18 level. We kept on seeing resistance. It broke it, but fail, and then we fail, and the $200 or 200-day moving average, the red line, would break. And it really just kind of went sideways between 16 and 18 until this recent earnings when we finally took out all that resistance. And I think we're going up here to $30. So let's zoom out again and kind of see why I get that target. So from these highs to lows, here you can kind of see that $18 level, that 61.8 resistance just sold every time, right? And eventually took out the 20s, took out the fibs, resistance, and now we're at 25. I target the 161.8 extension, but we have more targets. If it gets up here, you can start looking at the 261.8 extension at 42. And if you want to be greedy, I call this the greedy man's target, 423.6, way up at 62. What I find interesting is kind of lines up with the 61.8 I showed you earlier on that first chart at $60. So a lot of meat on the bone here. When you're looking time frame, shorter time frame, I think we can get to this $30 level at the end of the year or maybe in January, right? And then maybe we get a retracement, back up, maybe middle of the year, 42, retracement, back up, and perhaps in the next couple of years, if that earnings momentum keeps going, we're going to see a stock come way up here and turn into, a 30 to $40 billion company. So that's what we're looking for. That is UiPath, ticker symbol PATH. Thanks for listening. Here is Tracy with her top stock pick.
Thanks, Jeremy. I have a number one stock that isn't quite as glamorous as what Jeremy was just covering, but sometimes you don't have to be a genius, as our chief equity strategist, John Blank, often says. And my stock is JP Morgan Chase, the big bank. Should you be looking at the banks again? Yes, you should. They're still cheap, even though they all rallied in November in that big rally that we just had. So they are off the lows, but they're still struggling over the last couple of years. And as I said, they still remain cheap. How cheap is JP Morgan? It does have a PE under 10, but you really need to look at price to book ratios for the banks. And JP Morgan now, after the recent rally, has a price to book ratio of 1.56. So what does that mean? Well, the bank analysts always say to buy at 1 and sell at 2 on the price to book ratio. So you can see JP Morgan isn't as cheap as the 1, but it's not yet at the 2. So it still has some upside that should be in this stock going forward in the next couple of years as the banks hopefully come out of this funk that they've been in both last year in 2022 and now here in 2023. But let's take a look at what is actually happening with JP Morgan's estimates, because this will give you a better idea of why the analysts are so bullish and how it's gotten the number one rank strong buy. So The estimates for the number one ranks usually means that that's higher. And we're going to take a look here at what is happening. And the place I always go is here on the agreement. And you can see 9 estimates are higher in the last 60 days. So that would have been after JP Morgan's last earnings announcement. Analysts got bullish because they were too pessimistic. So 9 have raised for this year. 12 over here have raised for next year. So they are feeling better already about 2024. What does that look like on the estimates? If you go down for the magnitude change, it is up now for this year to 1684, up from the 1606 before the earnings report. And the same over here, we're now at 1551, up from 1468. But you can see there is a decline expected here between these 2 years, but not as bad as what it was prior to this last earnings report. Like I said, the analysts had gotten pretty pessimistic about the big bank earnings going into next year, and now they're not as pessimistic. This is about a decline of 7%. But let's take a look and see what it looks like on the chart. I like to look at the price and consensus chart on Zacks because it's just such a great chart visually to see what's going on with the earnings estimates. And you can see we finally have the estimates on the rise here. You have 2023 looking pretty bullish, but as I just said, 2024 expected to be down 7%. But it's now going in the right direction as well. And what we want to see is it going up. That's the whole point of the Zacks number one rank. The analysts have gotten more bullish on this stock. They've raised their earnings estimates, and they've raised them several times now, it looks like, from this chart, and it's going in the right direction. Now, we do have some data on here about 2025 already, even though that's quite a ways out. And you can see they're not as pessimistic about 2025 either. And that, too, is going in the right direction. Now, this stock, as I said, is up off the recent lows. It's near a 52-week high, but the banks have been so depressed. You can see that even here at a 52-week high, it's still not anywhere back to 2021 highs, but we'll take it because maybe we're going to get a breakout here and test those 2021 highs. As I said, the shares are still cheap here. And so I feel like there's still some room left to run in the banks. They've been ignored all year long, and especially during the banking crisis. Of course, nobody wanted to be in any of these, but the recent rally is showing that maybe there is some value here, but also a better outlook for next year for 2024. And what we really need is for these banks to rally into next year and in 2024 to keep this overall rally going, both in the small caps and the large caps. We need the banks. So will this be the breakout? We don't know, but JP Morgan's got that number one strong buy rank again, and it's still cheap. So my top stock pick is JP Morgan Chase, ticker JPM. And as always, you want to be sure to get all of our top stock picks of the week. We do them every week here. So be sure to subscribe to our YouTube channel. You can get it at Zacks.com/YouTube, but be sure to get it somewhere. And we'll see you again next week with some more top stocks.